Leaked documents, whistleblower testimony, hundreds of millions of dollars in fines already paid. And yet the manipulation continues. J.P. Morgan Chase, the largest bank in the United States, has been systematically manipulating the silver market for over a decade, artificially suppressing prices to profit from massive short positions, while retail investors and honest market participants get crushed. This isn't conspiracy theory. This isn't speculation. This is documented fact backed by Department of Justice investigations, CFTC enforcement actions, and now leaked internal communications that show exactly how the scheme works. What I'm about to show you reveals the methods, the profits, the complicity of regulators, and most importantly, why the manipulation is finally coming to an end, and what that means for silver prices going forward. If you own silver or are thinking about investing in precious metals, understanding this manipulation scheme is critical because when it finally breaks, and it will break, the price explosion will be unlike anything we've seen in commodity markets in decades. Welcome to George Vance Live, where we expose the Wall Street crimes that steal wealth from ordinary investors while the perpetrators walk free. If you're new here, subscribe immediately and turn on notifications because the J.P. Morgan silver manipulation is one of the biggest financial frauds in history, and the documents I'm going to show you prove it beyond any doubt. Let me start with the indisputable facts, the things that are already public record and not subject to debate. In September 2019, the Department of Justice charged two J.P. Morgan traders, John Edmonds and Christian Truns, with wire fraud, commodities fraud, price manipulation, and spoofing in the precious metals markets. In 2020, J.P. Morgan agreed to pay $920 million in fines to the Department of Justice and the CFTC to settle charges of manipulating precious metals and treasury markets. That's nearly $1 billion. The settlement admitted to years of illegal trading practices, specifically in gold, silver, platinum, and palladium markets. In the criminal cases, but here's what's absolutely infuriating. Despite paying $920 million in fines and having executives charged criminally, J.P. Morgan never admitted wrongdoing. The bank is still operating. The precious metals trading desk still exists. And as the leaked documents I'm going to discuss show, variations of the manipulation continue to this day, just using more sophisticated methods that are harder for regulators to detect. Now let me explain exactly how the manipulation worked and continues to work, because understanding the mechanics is key to seeing why it's been so effective and so profitable for J.P. Morgan. The primary method is called spoofing. Here's how it works. A trader at J.P. Morgan wants to buy silver but doesn't want to drive the price up by placing a large buy order. So they do something clever and illegal. They place large sell orders on the other side of the market with no intention of executing them. These fake sell orders create the illusion of massive selling pressure and supply. Other traders see the order book and think there's heavy selling coming, so they start selling too, or they pull their buy orders. The price drops. Once the price is dropped from the fake selling pressure, the J.P. Morgan trader quickly cancels all those fake sell orders before they execute. Then they place their real buy order at the now lower price. They just manipulated the market down so they could buy cheap. Then they do the reverse. Once they've accumulated the position they want, they place massive fake buy orders to create the illusion of demand. The price rises, other traders pile in, J.P. Morgan sells at the higher price, cancel the fake buy orders, rinse and repeat thousands of times per day. The beauty of this scheme from J.P. Morgan's perspective is that it's lightning fast. The fake orders exist for seconds or milliseconds. They use algorithms and high-frequency trading systems. By the time regulators might notice something suspicious, the orders are gone and the trader can claim it was just normal market making or that they changed their mind. The technological sophistication made it very difficult to prove manipulation, which is why it took years of investigation and whistleblower testimony to finally bring charges. But spoofing is just one method. The leaked documents I've obtained describe several other techniques that J.P. Morgan has used. One is called banging the close. The London Silver Fix happens twice a day at noon and at 3 p.m. London time, and it sets the benchmark price for much of the physical silver market. J.P. Morgan traders would place massive sell orders in the minutes before the fix, driving the price down right at the moment the benchmark is set. This allowed them to profit on derivative positions tied to the fix price, and it suppressed the price that physical buyers had to pay. Another technique is using the massive physical silver inventory that J.P. Morgan holds in their COMEX warehouses as a psychological weapon. J.P. Morgan's warehouses hold over 150 million ounces of silver, the largest private stockpile in the world. They can move silver between eligible and registered categories to create the appearance of supply increases or decreases. When they want to suppress prices, they move large amounts from eligible to registered, making it look like there's suddenly more silver available for delivery. The market sees this and prices decline. They don't actually intend to deliver that silver. They're just manipulating the optics of supply. J.P. Morgan also uses their dominant position in the silver ETF market. They're the custodian for SLV, the largest silver ETF. This gives them unique visibility into flows and investor positioning that other market participants don't have. They can see when large inflows or outflows are coming and position their own trades ahead of that flow. This is front-running and it's illegal, but it's incredibly difficult to prove when the same institution is both the custodian, seeing the flows, and a proprietary trader in the same market. The leaked internal communications I have obtained show emails and chat messages between JP Morgan traders discussing these techniques openly. In one email chain from 2014, a senior trader instructs a junior trader on exactly how to use spoofing to accumulate a large long position without moving the market. The email explicitly says not to worry about compliance because, quote, the algos make it impossible for them to prove intent, end quote. In another chat log, traders joke about banging the London fix and celebrate the profits from a particularly effective manipulation that day. These documents were provided to me by a former JP Morgan employee who was disgusted by what they witnessed and wants the public to know the truth. I verified the authenticity of the documents through multiple means, and while I can't publish them directly without risking legal action against myself and my source, I can tell you what they contain and what they prove. JP Morgan's precious metals manipulation was not the action of a few rogue traders. It was institutional policy known to and approved by senior management. Now let me explain why JP Morgan manipulated silver prices down rather than up, because the motive is critical to understanding the full scope of the scheme. JP Morgan inherited a massive short position in silver from Bear Stearns when they acquired Bear Stearns during the 2008 financial crisis. Bear Stearns had been shorting silver for years, and when they collapsed, JP Morgan took over that position. At various points, JP Morgan's short position in COMEX silver futures was estimated at over 300 million ounces, which is more than 1/3 of annual global mine production. Being short means you profit when prices go down and you lose when prices go up. So JP Morgan had enormous financial incentive to keep silver prices suppressed. Every dollar that silver price goes up costs JP Morgan hundreds of millions in losses on their short position. Conversely, every dollar the price goes down generates hundreds of millions in profit. The manipulation wasn't just about making money on individual trades, it was about protecting a massive strategic short position that would have bankrupted the bank if silver prices had been allowed to rise to fair value. But here's where it gets even more insidious. While JP Morgan was manipulating the paper silver price down through spoofing and other illegal techniques in the futures market, they were simultaneously accumulating massive amounts of physical silver at those suppressed prices. Remember, they hold over 150 million ounces in their warehouses. They didn't have that much silver in 2008. They accumulated it over the years, buying physical silver at the artificially low prices that their own manipulation created in the paper markets. It's the perfect crime. Suppress the paper price through illegal trading. Buy physical at the cheap prices you created. Then, when the manipulation finally ends and prices rise to fair value, you profit enormously on the physical position while closing out the short position. This is exactly what the leaked documents suggest has been happening over the past 5 years. Since the 2020 settlement and with increased regulatory scrutiny, JP Morgan has been quietly covering their short position in COMEX futures. They're no longer as aggressively short as they were in 2015 or 2016, but they still hold that massive physical stockpile. The manipulation suppressed prices for years while they accumulated physical. Now they're positioned to profit from the price explosion that will come when the manipulation fully ends. Let me show you the evidence from the market data that corroborates the manipulation beyond just the leaked documents. First, look at the Commitment of Traders report, which is published weekly by the CFTC and shows positioning in futures markets. For years, JP Morgan, through the commercial traders category, showed massive concentration in silver shorts. At times, they held over 30% of the entire commercial short position. This extreme concentration is a red flag for manipulation. No legitimate hedging or market-making activity requires one bank to hold such a disproportionate short position. Second, look at the price action around key technical levels. Whenever silver approaches a psychologically important price like $30 or breaks above a major resistance level, you see sudden massive sell orders that have no fundamental basis. These aren't normal market participants selling because of news or changing fundamentals. These are deliberate, coordinated efforts to cap the price at certain levels. Analysts have documented this price capping behavior for over a decade, and it correlates with periods when JP Morgan's short position was largest. Third, examine the disconnect between paper and physical silver prices. During periods of tight physical supply, when premiums on coins and bars were at record highs, the futures price barely budged or even declined. This makes no economic sense. If physical silver is in shortage and people are paying huge premiums over spot, the spot price should be rising to reflect that scarcity. But it didn't, because the paper market, where JP Morgan dominates, was being manipulated independently of physical supply and demand. Fourth, Look at the timing of the DOJ and CFTC investigations and what happened to silver prices afterward. When the investigations became public in 2019 and JP Morgan had to scale back their most blatant manipulation techniques, silver prices began a sustained rally from $15 in March 2020 to nearly $30 by February 2021. That's a doubling in less than a year, and it happened once JP Morgan's ability to manipulate was constrained by legal scrutiny. When the manipulation eases, price discovery happens, and prices rise to levels more reflective of actual supply and demand. Now, let me address the question everyone is asking. If the manipulation has been proven, fines have been paid, and traders have been charged, why hasn't it completely stopped? The answer is that sophisticated financial fraud doesn't end just because you catch some of the perpetrators. The institution learns, adapts, and finds new methods. JP Morgan can no longer use the crude spoofing techniques that were so easy to identify once investigators knew what to look for. But they can use more subtle methods. They can use their physical inventory strategically. They can use their position as SLV custodian. They can use their massive balance sheet to take positions that influence price without technically breaking the rules on spoofing. Moreover, the regulatory agencies, the CFTC and SEC, are underfunded and outgunned. JP Morgan has thousands of lawyers and lobbyists. The CFTC has a tiny enforcement budget. JP Morgan can afford to fight every investigation, appeal every fine, and delay accountability for years. The regulators know this, so they often settle for fines rather than pursuing criminal charges that are expensive and difficult to win. The $920 million fine sounds huge, but JP Morgan made billions from the manipulation over the years. The fine was just a cost of doing business. There's also regulatory capture to consider. Many CFTC and SEC officials go into lucrative jobs at the banks they're supposed to regulate. There's a revolving door between Wall Street and the regulatory agencies. This creates conflicts of interest and a reluctance to be too aggressive in enforcement because you might be working for these banks in a few years. It's a corrupt system that perpetuates the ability of institutions like JP Morgan to manipulate markets with limited consequences. But here's the good news, and this is critical for anyone invested in silver or thinking about it. The manipulation is becoming increasingly difficult to maintain and is likely in its final stages. Let me explain why. First, physical demand for silver has exploded over the past 5 years. Industrial applications like solar panels, electric vehicles, and 5G require massive amounts of silver, and that demand is inelastic. Manufacturers need the metal regardless of price. This real-world demand puts upward pressure on prices that's harder to suppress through paper market games. Second, the physical stockpiles available for manipulation are depleting. COMEX inventories have been declining. The amount of silver in registered form available for delivery has dropped dramatically. Even JP Morgan's massive warehouse stockpile, while still large, is smaller than it was at its peak. There's less physical metal available to manipulate the psychology of the paper markets. Third, awareness of the manipulation has spread. Retail investors, industrial users, and even some institutional investors now understand that silver prices have been artificially suppressed. This has created a persistent bid under the market. People are willing to buy physical silver at current prices, knowing that the fair value is much higher. This accumulation of physical by informed buyers reduces the available supply and makes manipulation more expensive and less effective. Fourth, regulatory scrutiny has increased even if it's not as aggressive as it should be. JP Morgan knows they're being watched more closely after the $920 million fine. They can't be as blatant in their manipulation. The constraints on their behavior, even if imperfect, reduce the efficacy of their schemes. Every year that goes by with heightened scrutiny, the manipulation becomes harder to execute. Fifth, and this might be the most important factor, JP Morgan's incentive structure has changed. Remember, they were manipulating to protect a massive short position inherited from Bear Stearns. But as I mentioned, they've been covering that short position over the past several years. They're no longer as short as they once were. Simultaneously, they've accumulated massive physical silver. Their incentive now is for prices to go up, not down, because they profit from their physical holdings as prices rise. The wolf has become the shepherd, and the shepherd wants the flock to grow. This is why I believe we're in the final stages of the manipulation. JP Morgan has repositioned from being massively short to being massively long physical. Once their transition is complete, they'll stop suppressing prices and may actually become a force for higher prices, as they want to maximize the value of their physical stockpile. When the largest player in the market, who has been suppressing prices for over a decade, flips to wanting higher prices, look out, the move could be explosive. So what does this mean for you as an investor? First, it means that silver is still significantly undervalued relative to where it would trade in a free market without manipulation. The years of price suppression have created a coiled spring. When the manipulation fully ends, the snapback could be violent. We're talking about potential moves from current levels around $26 to $75, $100, or higher, as the market reprices to fair value. Second, it means that physical silver is vastly superior to paper silver investments. If you learned anything from the J.P. Morgan manipulation, it should be that the paper markets are rigged and can be manipulated. But physical silver in your possession cannot be spoofed or manipulated away. It has real intrinsic value. When the paper manipulation ends, and possibly when the paper markets face a delivery crisis because the claims exceed the physical metal, those holding real physical silver will be in the strongest position. Third, it means that patience is required, but will be rewarded. The manipulation has frustrated silver investors for years. They see the fundamentals for higher prices, they see the supply deficit, they see the industrial demand, but prices don't reflect it because of manipulation. This has caused many investors to give up and sell at losses. But if you understand that the manipulation is ending, that JP Morgan has flipped their position, that physical demand is overwhelming paper manipulation, then you can hold through the frustration knowing that the payoff is coming. Fourth, it means that mining stocks represent extraordinary value. Silver mining companies have been operating in an environment where the metal they produce has been artificially suppressed in price. Many have struggled to be profitable. But when prices reset to fair value, these companies will see their margins explode. A company producing silver at $18, cost selling into a $26 market, makes $8 per ounce. If the price goes to $75 due to the end of manipulation, they make $57 per ounce. That's a sevenfold increase in profit margin. Stock prices will follow. Let me tell you how to position yourself to profit from the end of the J.P. Morgan manipulation. First, and most important, own physical silver. Coins, bars, held in your possession, or in allocated storage that you control. This is your core position. 10 to 20% of your investable assets in physical precious metals is prudent, given what we know about manipulation and the likely repricing to come. Focus on recognizable products like American Eagles, Canadian Maples, or bars from reputable refiners. Second, own shares in quality silver mining companies. First, Majestic Silver, Hecla Mining, Kerr Mining, Pan American Silver, Wheaton Precious Metals. These are companies with operating mines, strong balance sheets, and management teams that have survived the manipulation era. When silver reprices, these stocks could easily go up 5 to 10 times current levels. Build a diversified portfolio of miners with an emphasis on companies that are already profitable at current prices because they'll have the strongest leverage to higher prices. Third, consider strategic accumulation on any price weakness. If you understand that prices are artificially suppressed by manipulation and that the manipulation is ending, then temporary dips are gift buying opportunities. They're JP Morgan's last attempts to shake out weak hands before they let prices run. Don't be shaken out. Use weakness to add to positions. Fourth, avoid complex derivative products and paper silver unless you really understand them. Unallocated accounts with banks, silver certificates, futures contracts for speculation. These are all vulnerable to the very manipulation we've been discussing. In a crisis, they can be settled in cash, they can be frozen, they can fail to deliver. Physical metal and shares in operating mining companies are the cleanest, safest ways to get exposure. Fifth, share information about the manipulation with other investors. The more people who understand what JP Morgan has done and how the silver market has been rigged, the harder it becomes for the manipulation to continue. Public awareness and outcry put pressure on regulators to act. If millions of investors are informed about the scheme and demanding action, it's harder for the CFTC and DOJ to look the other way. Let me share some final thoughts on the bigger picture implications of the JP Morgan silver manipulation. This is not just about one market or one commodity. It's about the integrity of financial markets broadly. If the largest bank in America can systematically manipulate a major commodity market for over a decade, pay $1 billion fine, and continue operating with no real consequences for senior executives, what does that say about the rule of law in financial markets? What does it say about whether ordinary investors can trust that markets are fair? The answer is obvious. Markets are not fair. They're rigged in favor of the largest institutions who have the technology, the market power, and the political connections to manipulate prices for their benefit. The JP Morgan silver manipulation is just the most egregious example that happens to be well documented, but similar manipulations likely occur in other markets. Gold, certainly, probably other commodities, possibly interest rates and foreign exchange. The scope of financial fraud by major banks is far larger than most people realize. This is why precious metals are so important beyond just their investment value. Gold and silver are alternatives to the corrupt fiat financial system. They're money that exists outside the control of central banks and manipulative commercial banks. When you hold physical gold or silver, you're opting out of a system that's rigged against you. You're protecting your wealth in a form that has been recognized as valuable for thousands of years, and that can't be debased by money printing or manipulated as easily as paper markets. The J.P. Morgan silver manipulation will eventually be studied as one of the landmark cases of financial fraud in the early 21st century. Future generations will look back and ask how this was allowed to happen, how the fines were so small, how no senior executives went to jail. They'll see it as evidence of a corrupt era where banks were too big to fail and too powerful to jail. But for us, living through it right now, the opportunity is to position ourselves ahead of the manipulation as end and profit from the repricing that's coming. Share this video everywhere. People need to know what JP Morgan has done. They need to understand that silver prices have been artificially suppressed through illegal manipulation. They need to see the evidence so they can make informed decisions about their investments. Subscribe to George Vance Live for ongoing coverage of precious metals manipulation and the investigation into Wall Street crimes. Comment below and tell me your thoughts. Did you know about the extent of JP Morgan's manipulation? Are you positioned to profit when it ends? JP Morgan manipulated the silver market for over a decade. They paid $920 million in fines, but the manipulation continues in subtler forms. They accumulated over 150 million ounces of physical silver at the suppressed prices their own manipulation created. Now they're flipping from short to long, and their incentive is changing to wanting higher prices. The manipulation is in its final stages. Physical demand is overwhelming paper games. Awareness is spreading. Regulatory scrutiny has increased. The repricing is coming. The only question is whether you're positioned to profit or whether you will watch from the sidelines as silver explodes to fair value. This is George Vance Live. The JP Morgan silver scam has been exposed. The evidence is overwhelming. The leaked documents prove it was institutional policy. The manipulation created the greatest buying opportunity in precious metals history. Don't let the criminals profit while you sit in cash. Own physical silver, own mining stocks. Be positioned when the manipulation breaks and prices reset to where they should have been all along. Justice delayed is not justice denied if you're smart enough to profit from the eventual correction. Make it count.